Greetings traders and welcome back. Thank you for joining me again as we dive into another survival guide. Chris here bringing you some information today on how to trade futures. This is going to cover exactly what futures are, as well as how the futures markets work, and how you can get started, as well as good practices to employ and begin utilizing in your futures trading career as you just first get your wheels going. If you plan on taking the Gauntlet Mini and passing and becoming a funded trader, well, the first step to doing that is understanding what in the world futures are to begin with, and that's exactly where we're going to start today. If you already know what futures are, well then this may not be the video for you, but we do have a large amount of other educational content, as always, that may be very appealing from you, ranging from beginner to extremely advanced content, so make sure you check it out. But without further ado, let's get going. The first step to learning how to trade futures as you begin your futures trading career is, of course, to cover exactly what futures are. And futures is a term that is generally used to refer to futures contracts, which are a derivative financial contract that obligates the parties to transact an asset at a predetermined future date and price. So, what does this mean? This means that we're looking at an opportunity to buy something, but we're deciding on which price we're going to buy it at in the present time for a future date, or which price we're agreeing to sell something at a future date. And the contract ensures that both parties will fulfill their side of the contract when that time comes. That is the general premise of what futures are. It initially began as a way of farmers to ensure something like the price of a crop or the amount of grain that they were going to sell. They wanted to ensure that despite potential weather outcomes or shortages, that they would be guaranteed a specific amount of money at some point in the future, even though it does present the opportunity to lose money if the price is higher in the future than the agreed upon price at the time that the futures contract was signed. But the idea is to provide a level of stabilization to the trading process. In the most basic form, the futures market and a futures contract is just that agreement to buy or sell a particular asset, like we said. And the integrity of the futures markets themselves is based upon the participants and, in the modern era, clearing houses. A clearing house is best described as an intermediary position between the buyers and the sellers. It sits in between the buyers and the sellers to more or less smooth out the transaction process of all different types of financial instruments. Their various responsibilities include settling trading accounts, maintaining margin obligations, trade reporting, regulating delivery, and ultimately clearing the trades themselves. The fact that all transactions are completed through a clearinghouse gives investors on each side of the trade confidence that everything will be all right with their agreement. It is this confidence that has encouraged huge volumes in index futures contracts, where some investors will hedge their bets, some will forward buy their businesses, and some will opt for outright speculative investment by itself. There are also those who will buy and sell individual futures contracts to create various strategies, maximizing their upside, but hopefully limiting their downside. In order to understand how futures trading works in modern day times, all we have to do is look at a chart here of the E-mini S&P 500. Now, once again, this is the E-mini S&P 500, not just the S&P 500 itself. The reason being, the S&P 500 is going to be the index level times 250. That means the numbers that you're seeing on the side times 250 if it was the S&P 500. And that means our entry over here on the left at 3205 would be valued at $801,000. It'd actually be a little bit more than that, but an extremely large amount of money, and not a lot of traders have that type of capital to be able to open and maintain that type of a contract as is. So other things were introduced, such as margin, as well as the E-mini variation, which is what we're looking at, of the S&P 500. The E-mini description refers to the fact that each contract is valued at 20% of the original S&P 500 futures index, and that is what we're looking at. So this is going to be the index level times 50, and what that means is when we open a contract at a number of 3205.50, that means each contract is going to be valued at just over 160,000 instead of 800,000. Now, you may be thinking, oh my goodness, I don't have $160,000 to open an individual contract, and you're saying that's the cheaper one. Well, guess what? That's where that term that I mentioned called margin comes into play. So even though the full value of the Reduce E-mini S&P 500 index is still a stretch for the vast majority of retail traders, they have provided what is called margin, which means you put up a relatively small percentage of the contract value with potential adjustments depending upon market movements. So that means that if we were looking to open a contract, margin in simple, or in short I should say, would allow us to open the contract without needing that $160,000. Instead, we might only need, say $3,000, for example, to open one contract or what have you. The idea is going to be different and dependent on whatever index that we're looking at, of course. It's going to be dependent on how much leverage we're using, how much margin is required, and a various number of other factors as well. But the concept is that we don't need the amount of money that the contract itself is worth when we're trading on the futures market. And the way that we're making money is if this contract at the price or valuation of the $160,000 rises to $32.67, well then in this case, if we sell off at $32.67, that means we'd be selling off at somewhere around $163,375 for a contract value, which means we're making roughly $3,000 in profit if we buy on the left and sell on the right. And even though we don't have $160,000 itself, if we were on, say, 10% margin, our contract value at 10% would actually only be $16,000 in order to open up. So there's a variety of ways that we can go about trading larger numbers without having those large numbers themselves. So this is just a brief introduction into how the concept of futures trading works. And of course, the valuation based on how it changes, whether we're buying it and it goes up, or whether we're selling it and it goes down, is how we're going to make money. If we buy it and price then falls, we're going to lose money. If we sell it and price falls, then we're going to make money. The risks associated with futures trading can be summed up into four essential categories. We have leverage, margin, liquidity risk, as well as operational risk. With leverage, this is more or less what we just previously mentioned. So let's look at this chart here on the right to understand how leverage and a margin call would work. So in simple terms, if our margin call is, say, 10%, then we are only paying $10 for an investment exposure of, say, $100, because what is 10 times 10? That is 100. This works perfectly if our timing is right and the markets move as we expect. Unfortunately, if our timing is off and the markets move against you, then a 1% shift in the S&P 500 index, for example, would lead to a 10% loss. It is very important that we use stop loss limits when we are trading because it helps protect us should the market go against us, and that way we don't amplify our losses. Then we have margin. Now that we knocked off leverage, margin is going to be the cost of acquiring our initial futures investment position. That's what we call initial margin. When we have a live position, our broker will also calculate what is known as maintenance margin. This is the minimum balance that is required to keep the position open. And this will include the value of our futures contract investment and any additional funds that are held on deposit. So in the example that we were talking about with the margin call, if we had a margin call of just over, say, 16,000 or so, give or take a dollar or two, the maintenance margin could be set at around, say, 14,400. So that would be 10% less than the initial margin. If we were at 16K and we had a maintenance margin set of 14.4, that's about 10% less, right? Now, the initial funds, if they fall to, say, 14,000, below that 14,400 barrier, we would be required to bring our funds back to 16,000 to reset to our initial margin. And failure to deposit additional funds would likely lead to the position being closed out and the loss being booked against our account. Then we have liquidity risk with margin knocked out of the way. Liquidity risk, if you deal on a futures market, liquidity risk is something that is going to reference the possibility of a contract not being filled or being filled when you want it to be. But if it's filled when you want it to be, that's not much of a risk. Liquidity is going to represent the availability for your decision to come into fruition. It's your ability to purchase a contract at a price you want it. Now, in today's day and age, the vast majority of the futures markets out there are extremely liquid, and there should really be no issue if you're trading during any reasonable times between the cash hours that you should have any issue getting filled or getting out of a position for that matter, unless you're with an insane amount of money and you're looking to open, say, 1 million contracts, in which case you might have a little bit of difficulty getting in all at one price. But liquidity risk is something to be aware of, because if you're trading an asset that isn't liquid, you have the potential for what is called slippage. Your order may not fill if you have a market order set at the price you want. Instead, it may fill quite a bit farther away as the first available price is offered. Then we have operational risk. And operational risk, in theory, the operational risk is going to be involved with any type of investment or any type of business, which is best described as human error. Now, if we dig a little deeper, we may find that this human error occurred as a consequence of inadequate staff training or placing personnel in positions for which they weren't experienced. But the easiest way to sum up operational risk as it pertains to training is going to contain things like making mistakes or not paying attention to certain things that we actually can control that unfortunately due to human error we succumb to. So that is what operational risk is, and that is something to be aware of as well in the trading world. For those that are interested in getting started with futures trading, there are things that we need to understand and be aware of. And the first is the expiry dates. We need to understand at what point in time our contract expires. Futures contracts have expiries that are usually in quarterly or 3-month series. For example, if you were to buy a futures contract that expires in, say, March, June, September, or December, that means if we buy the March series in January, then at the end of March, the contract will expire and the settlement will be required. So we need to be aware of the expiry dates when we're trading futures, because delivery is required if we do let our contract go to expiry. Then we have the leverage works both ways aspect. This means that leverage is a double-edged sword. If we're using an amplification process on our trading, it's nice when we're winning because it amplifies our gains, but when we're losing, it also amplifies our losses. Number 3 is trading strategies and liquidity. We need to be aware of what type of market we're trading. Is it a liquid market? As well as have a solid trading strategy in some type of fundamental or technical analysis based manner. Then diversification. When we're trading in any type of a market, making sure that we're diversified to some degree is always a good idea. The adage goes, never keep all your eggs in one basket. Then we have futures trading as a full-time job. Now, this could be tilted because it doesn't necessarily have to be a full-time job, but becoming a successful futures trader just about is. Becoming a successful futures trader requires education, it requires practice, it requires actual implementation. There's a lot of stuff that goes into actually reaching the successful portion, and becoming a successful futures trader is definitely a full-time job. And once you become successful, you can choose to not spend so much time, but generally speaking, most futures traders that are successful do treat it as a full-time job. And then number 6 is leave your ego at the door, and this is extremely important as well because ego has no place in the trading world. We need to be almost robotic and calculated in our decision-making process. Very rarely do our emotions positively impact our trades, and this is always important to remember. Getting involved and getting started trading futures is done via 2 general ways. There's investing via a brokerage, and then there's investing via a prop trading firm like us at Earn2Trade. Now, via the brokerage aspect, the concept is relatively simple. To open an account, an investor approaches a broker, places money on a deposit, and then invests in those futures contracts like we talked about. All the transactions are carried out by the broker on the instruction of the client, who benefits from the resulting profit and or loss. and trading at the prop firm. So prop trading or proprietary trading is trading trading involved using other money, not your money. It's using the firm's money. So the idea here is very appealing to new traders or to traders that don't want to risk their own capital. And the way this generally works is simply by doing something like passing the Gauntlet or the Gauntlet Mini. And if you're able to pass the Gauntlet Mini, you have the opportunity to receive a funded trading account. That is your trading offer that you're trying to pass for. And the way that works is you're going to sign up for whatever account size that you want, whether it's $25,000 or $150,000, and you're going to showcase your skills, and if your skills pass the test, then you are given that account. And the way the firm makes money off of this is by taking a small percentage of the earnings thereafter. Building a trading plan is another crucial as well as characteristic aspect of successful futures traders. And building a trading plan entails figuring out what your motivation for trading is. This means writing down what your goals are, as well as what level of risk you're willing to consider, as well as how much investment capital is available. And something else that is worth noting into a trading plan is outlining your trading strategy. If you put pen to paper and actually write down what your trading strategy is, as in what rules it's going to take for you to open a buy or what rules it's going to take for you to open into a sell, that is something that will allow you to systematically figure out what is working, what is not working, and change one step at a time and slowly progress into becoming a more efficient and profitable trader. Another important step of the trading process when you begin your futures trading career is choosing an asset and understanding that asset. All assets are not created equal. Some assets may have more liquidity, other assets may provide certain movement characteristics that favor your particular trading style more so than another asset. I personally like trading crude oil, I like trading the E-mini S&P 500, as well as the NQ, but they may not be the assets for you, or maybe they are. I find that the E-mini S&P 500, for example, is extremely liquid, as well as relatively stable and beginner-friendly for that reason. But choosing an asset is another crucial aspect of beginning your trading career. And after that, the next step is practice. Start putting practice down. Start executing trades on a demo account. Never execute live until you can actually show that you've been profitable with your decision-making process already. It's all too easy to open a demo account somewhere and not risk money while you're actually trading real market moves. The value from that is undescribable, and it is something that is an absolute must. But until next time, folks, thank you for joining me yet again for another survival guide. I wish you all the best of luck, happy trading, and I will see you all very soon.